There's a moment in every bubble when the warnings stop being heard, when the people who survived the last crash, who watched their savings vanish and their retirement funds collapse, try to tell the next generation what's coming, and get laughed at. We're in that moment right now. The Shiller price-to-earnings ratio sits at 39, the second highest valuation in market history, surpassed only by the peak of the dot-com bubble before it imploded. 30% of Gen Z began investing in early adulthood, compared to 9% of Gen X and 6% of boomers at the same age. 40% of day traders are between 25 and 34 years old. Over 20% of Gen Z and millennials hold crypto accounts. They're pouring money into meme stocks driven by social media hype, into coins that exist purely for virality, into markets they don't understand with confidence they haven't earned. And the most dangerous part isn't the speculation itself. It's that they believe the older generation warning them simply doesn't understand how different things are now. That's the exact same belief every generation holds right before the collapse. In 1929, office workers buying stocks on 10% margin ignored warnings from those who remembered the panic of 1907. In 2000, day traders quit their jobs to trade tech stocks, dismissing concerns from investors who survived Black Monday. In 2007, homeowners with subprime mortgages believed real estate could never fall. They were all wrong. History doesn't repeat, but it rhymes with perfect pitch. And right now, in 2025, we're hearing the same melody. Every financial mania begins with the same conviction. The old rules no longer apply. Technology has changed everything. The economy operates differently now. Anyone warning about historical patterns simply doesn't understand the new paradigm. This belief isn't new. It's the foundational delusion of every bubble, and it's stronger now than it's been in decades. The 1920s had the radio, electricity, and the automobile. Commentators declared a new era of permanent prosperity. Financial writers championed the idea that stock valuations no longer mattered because industrial productivity had fundamentally transformed economic reality. Radio Corporation of America became the speculative emblem of the age, its stock rising tenfold in less than 2 years, despite having no earnings to justify the price. Ordinary citizens, convinced they were witnessing a permanent shift, borrowed heavily to buy stocks. Margin accounts required only 10% down, allowing people with modest savings to leverage themselves into massive positions. When the crash came in October 1929, they lost everything. The late 1990s had the internet. Analysts declared that profit didn't matter anymore. What mattered was user growth, eyeballs, network effects. Traditional valuation metrics were dismissed as outdated thinking from people who didn't understand the digital revolution. Plumbers and mechanics quit their jobs to become day traders, convinced they'd discovered a path to effortless wealth. The NASDAQ rose 600% between 1995 and 2000. Then it collapsed, erasing $5 trillion in market value. Fortunes built on belief vanished in months. Today's delusion centers on democratized access and technological efficiency. Commission-free trading apps, social media coordination, and fractional shares have supposedly leveled the playing field. Young investors believe they've outsmarted the system by organizing on Reddit, by following influencers on TikTok, by riding momentum in meme stocks and cryptocurrencies. The barriers that once protected unsophisticated investors from themselves have been removed, reframed as gatekeeping rather than safeguards. And the result is millions of people with no financial education, no experience with market downturns, and no understanding of risk, making highly leveraged bets in the most overvalued market in history. The structural conditions mirror past bubbles precisely. The Shiller-Cape ratio, which smooths earnings over a decade to measure long-term valuation health, currently sits around 40. That's higher than 1929, higher than 2007, second only to the dot-com peak of 44. Historically, when the Cape exceeds 30, forward 10-year returns average near zero or turn negative. But young investors either don't know this or believe it doesn't apply to them. They're convinced this time is different. it never is. There's a legendary story from 1929 involving Joseph Kennedy Sr., father of the future president. Kennedy supposedly decided to sell his entire stock portfolio after receiving investment tips from a shoeshine boy. His reasoning was simple. When the most unsophisticated participants start giving stock advice, the market has run out of new buyers. The only direction left is down. The shoeshine boy indicator isn't about contempt for working people. It's about market saturation. When speculation moves beyond professional investors and even beyond educated amateurs to reach people with zero financial knowledge, the mania has peaked. There's no one left to recruit. The final wave of capital has entered. What follows is the collapse. That indicator is flashing red right now, except the shoeshine boy has a TikTok account with 2 million followers. Financial influencers with no credentials, no training, and no accountability are dispensing investment advice to millions of young people who treat it as gospel. A figure known as Roaring Kitty can post a cryptic image about GameStop and cause the stock to surge over 100% within hours, despite the company reporting a $32 million loss and declining sales. The price movement has nothing to do with fundamentals. It's pure social contagion, driven by collective belief that momentum can be sustained indefinitely. This wasn't possible in 1929 or 2000. Speculation required more friction then. Brokerage, accounts, phone calls, research reports. Information moved slower. Manias took years to build. Now they build in weeks. Meme stocks can rally and collapse within days. Cryptocurrencies can double or lose half their value in a weekend. The speed of modern communication has compressed the entire bubble cycle, removing the time needed for rational correction. By the time anyone realizes the momentum has reversed, the losses have already occurred. More than half of U.S. retail investors now lack a college degree. 40% of day traders are in their 20s and early 30s. Over 20% of Gen Z holds crypto, compared to 6% of boomers. These aren't people with disposable income making informed bets. Many are financially fragile, speculating with money they can't afford to lose, convinced they've found a shortcut to wealth that previous generations missed. They haven't. They've found the same trap that's been set every 20 years for the past century, repackaged with new technology and a fresh narrative. The Dunning-Kruger effect describes a cognitive bias where people with low competence in a domain overestimate their own ability. In investing, this manifests as young traders who've experienced nothing but rising markets believing they possess skill rather than luck. Research shows that only 24% of millennials demonstrate basic financial literacy. Yet surveys reveal that younger generations display higher confidence in their investing abilities than older, more experienced cohorts. This is a catastrophic combination: minimal knowledge paired with maximum certainty. Overconfidence leads to overtrading, excessive risk-taking, and poor diversification. Young investors chase high volatility assets because the potential returns feel more exciting than index funds. They concentrate positions in a handful of speculative bets rather than spreading risk. They ignore fundamentals entirely, relying instead on social media sentiment and viral momentum. When asked why they're buying a particular stock or coin, the most common answer is some version of "everyone's talking about it" or "it's going up." These aren't investment theses. They're symptoms of mania. The gamification of trading platforms accelerates this behavior. Apps use visual cues, celebratory animations, and reward structures borrowed from mobile games to make investing feel like entertainment rather than risk. Notifications ping when stocks move. Leaderboards rank top traders. The interface is designed to encourage frequent activity, not thoughtful analysis. And it works. Studies confirm that Gen Z displays the highest risk tolerance of any generation, followed closely by millennials. This isn't bravery, it's ignorance of consequences. The moral stakes here are significant. Financial illiteracy isn't a personal failing, it's a systemic one. Older generations focused heavily on academic education, but failed entirely to teach financial competence. Schools don't require courses in budgeting, investing, debt management, or risk assessment. Parents avoided discussing money. The result is millions of young people entering markets with no preparation, no context, and no understanding of how quickly speculative positions can destroy wealth. Research estimates that the gap between high and low financial literacy translates to around 80,000 euros in lifetime net worth difference. Low literacy correlates directly with higher rates of late fees, credit limit violations, and reliance on predatory lending. These aren't abstract problems. They're mechanisms of wealth destruction that target the most vulnerable. There's a proverb found across cultures. Wealth doesn't survive 3 generations. The Chinese say it directly. The Americans phrase it as shirt sleeves to shirt sleeves. The Italians have their version. The pattern is universal. Research confirms that roughly 90% of family wealth is lost by the 3rd generation. The cycle is predictable. Generation 1 builds wealth through sacrifice and discipline. Generation 2 maintains it, having witnessed the struggle required. Generation 3, born into comfort, destroys it through entitlement and carelessness. The current speculative bubble is the financial expression of this cycle. Baby boomers and Gen X built or preserved wealth through economic expansion, real estate appreciation, and stock market growth over decades. They provided abundance for their children, millennials and Gen Z, but failed to transfer the context of scarcity that informed their own financial decisions. The result is a generation that views wealth as entitlement rather than achievement, as something that should come quickly rather than something that requires patience and discipline. This manifests in risk-taking behavior that makes no sense from a preservation standpoint, but perfect sense from an entitlement psychology. Why invest in index funds yielding 7% annually when meme stocks can double in a week? Why save gradually when crypto can generate life-changing returns overnight? The mindset isn't greed, it's impatience born from comfort. Older generations had no choice but to build slowly. Younger generations, having never experienced real scarcity, believe rapid wealth accumulation is normal and achievable. The meme stock movement revealed another layer: resentment. Many young traders explicitly framed their GameStop positions as rebellion against Wall Street, against hedge funds, against a system they believe has rigged the game against them. They're not entirely wrong about systemic inequality. Student debt has exploded. Housing affordability has collapsed. Wage growth has stagnated while asset prices have soared. Younger generations face structural disadvantages their parents didn't. But responding to those disadvantages with high-risk speculation doesn't solve the problem. It amplifies personal exposure to the inevitable correction. Research even suggests that bias toward wealth and against poverty may form as early as 14 months of age, driven by instinctive negative assessment of those with fewer resources. If true, this developmental bias reinforces the social pressure to display wealth quickly and visibly, aligning perfectly with the instant gratification culture of social media. Crypto gains and meme stock wins are posted. Losses are hidden. The feedback loop encourages more risk, more speculation, more leverage. And it's building toward the same outcome every previous generation faced when they believed the rules didn't apply to them. Historical crashes unfolded over months or years. The 1929 crash began in October, but the full economic devastation took years to materialize. The dot-com bubble inflated over several years and deflated over several more. Even the 2008 financial crisis, though its acute phase hit fast, built over years of subprime lending and housing speculation. Modern bubbles don't have that luxury of time. Technology has compressed the entire cycle. Information moves instantly. Trades execute in milliseconds. Social media amplifies momentum in both directions, up and down. What took months in 1929 can now happen in days. Meme stocks demonstrate this vividly. Coordinated buying on Reddit can send a stock up 300% in a week, and coordinated selling or loss of interest can erase those gains in 48 hours. There's no gradual unwinding, no time for rational actors to step in and stabilize prices. The velocity of capital movement has increased exponentially, while human decision-making remains just as emotional and flawed as it was a century ago. This speed creates a terrifying dynamic. By the time most participants realize the momentum has reversed, they're already underwater. Selling accelerates the decline, triggering stop losses and margin calls, which force more selling, which accelerates the decline further. The cascade can't be stopped once it begins. And because so many young investors are concentrated in the highest volatility assets, meme stocks, crypto, leveraged positions, they'll experience the steepest losses when the correction comes. Worse, inexperienced investors tend to make the worst decisions during crashes. History shows that more money is often lost after the initial panic, when falling prices lure people into buying what they perceive as bargains on the way down. They don't understand that in a real correction, assets that fell 50% can easily fall another 50% from there. They confuse a temporary bounce with a bottom. They average down into collapsing positions, throwing good money after bad, and by the time they capitulate and sell, they've locked in maximum losses. The structural instability is worse now than in previous bubbles. Corporate debt levels are at historic highs. Margin debt, borrowed money used to buy stocks, sits near record levels. Retail investors have piled into options and other leveraged derivatives, multiplying their exposure. When the selling begins, these leverage points will amplify the decline. Forced liquidations will cascade across markets, and the people who entered at the top, convinced they were smarter than history, will learn the same lesson every previous generation learned. Markets don't care about confidence, only about math. 3 times in the past century, young generations ignored warnings from those who survived previous crashes. 3 times they believed their moment was different, that new technology or new access had changed the fundamental nature of markets. 3 times they were catastrophically wrong. In 1929, young office workers buying stocks on margin dismissed concerns from investors who remembered the panic of 1907. They believed radio, automobiles, and electrification had ushered in a new era where old valuation rules no longer applied. The Dow rose 6-fold between 1921 and 1929. Then it collapsed, losing 89% of its value by 1932. Millions lost everything. The Great Depression followed. In 2000, young day traders quit their jobs to trade tech stocks, dismissing warnings from investors who survived Black Monday in 1987. They believed the internet had fundamentally transformed economics, that profit didn't matter as long as growth continued. The Nasdaq rose 600% between 1995 and 2000. Then it collapsed, losing 78% of its value by 2002. Trillions in wealth evaporated. Fortunes built on belief vanished. In 2007, young homeowners and investors ignored warnings about housing valuations and subprime lending from those who remembered the savings and loan crisis of the 1980s. They believed real estate could never fall nationally, that financial engineering had distributed risk so effectively that systemic collapse was impossible. Housing prices doubled in many markets between 2000 and 2006. Then they collapsed, triggering the worst financial crisis since the Great Depression. Millions lost homes, jobs, savings. The global economy nearly collapsed. Now, in 2025, young investors are ignoring warnings from those who survived 2008. They believe commission-free trading, social media coordination, and crypto have changed the game. They believe they've found a way to beat the system through collective action and viral momentum. They believe the older generation warning them simply doesn't understand how different things are now. They're wrong. They're following the exact same script that led to catastrophe 3 times before. The Shiller-Cape ratio at 40, retail saturation at all-time highs, financial literacy at all-time lows, overconfidence at all-time highs, leverage at all-time highs, volatility concentration in the riskiest assets. Every single warning indicator is flashing red. The only question is timing. Maybe the correction comes in 6 months, maybe a year, maybe 2. But the pattern says it's coming. The math says it's inevitable. And when it arrives, it won't care about confidence or conviction or social media movements. It will simply reset prices to levels justified by fundamentals, destroying trillions in paper wealth in the process. No one can predict the exact trigger. It could be an interest rate shock, a geopolitical crisis, a corporate bankruptcy, a crypto implosion, or simply exhaustion of new buyers. But once the selling starts, the mechanisms that amplified the rise will amplify the fall. Margin calls will force liquidations. Stop losses will trigger automatically. Panic will spread through social media faster than it spread through any previous medium. And millions of young investors who've never experienced a real bear market will watch their portfolios collapse in real time. The human cost will be severe. Young people who invested money they couldn't afford to lose will face financial devastation. Retirements will be delayed. Homes won't be bought. Families won't be started. The psychological impact of watching years of savings vanish in weeks will be profound. Many will leave markets entirely, swearing off investing just as the best opportunities emerge. They'll buy at the top and sell at the bottom, locking in maximum damage. But the pattern also says something else. The older generation, warning them now, will not say, "I told you so," when the collapse comes. They'll feel sadness, not vindication, because they remember what it felt like to lose everything. They remember the shame, the fear, the years it took to recover. They're not warning the younger generation out of condescension. They're warning them out of recognition. They see themselves in 1987, in 2000, in 2008. They know how this story ends because they've lived it. The tragedy isn't that bubbles form. It's that each generation has to learn the lesson themselves. Warnings don't work. Experience is the only teacher. And the tuition is always paid in destroyed wealth, broken confidence, and years of recovery. Perhaps that's necessary. Perhaps each generation needs to feel invincible and then be humbled. Perhaps that's how financial wisdom is actually transmitted, not through lectures, but through scars. But that doesn't make the coming collapse any less predictable or any less preventable. The information is available. The history is clear. The patterns are obvious. The warning signs are everywhere. Young investors have every tool they need to protect themselves. They simply choose not to use them. They choose to believe they're different, that their moment is unique, that the rules don't apply. They're not different. Their moment isn't unique. The rules always apply. And in 6 months or a year or 2 years, when the correction comes and the losses mount and the confidence shatters, they'll understand what every previous generation understood too late. The people warning you weren't trying to hold you back. They were trying to save you from what they went through, and you didn't listen because you thought you were smarter. You weren't. You were just younger. And now you'll learn what they learned, the hard way. The only way anyone ever learns, through loss.